Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This is the week ahead for the week starting Monday, the 1st of April. Certainly, as ever, we have US jobs really dominating affairs, but we have got a few other interesting tidbits to get through. I'll take you through what we're looking out for and also some key trades around those events. First and foremost, here's a big picture overview on some of the big events that we have got. Of course, kicking off here with that CADJPY PMI number coming out of China. Also, we've got ISM PMI numbers coming out of the US. We do also have the final readings in terms of those PMI numbers. But of course, as with the final ones, it's generally a revision. So we don't necessarily see as much volatility. Tuesday, we see the RBA minutes coming out. We've got German inflation and the JOLTS job openings data coming from the US. Wednesday, we've got that all-important eurozone inflation reading. I provided a big picture video about that, so make sure to keep an eye out for that video. It gives you a deeper insight into what could happen on that front. ISM services PMI also coming out from the US on Wednesday. And then on Friday, we've got the big jobs report coming out of both Canada and in the US, of course, coming off the back of some periods of strength here for US non-farm payrolls. This should be a really interesting one, given current expectations around the Federal Reserve and the continued pushing back that we have been getting from different Fed members. The first area I want to talk about is the US. Of course, we've got the all-important jobs report on Friday, but as with any first week of the month, we also see a number of other jobs metrics released in the lead up to that report. First and foremost, though, I wanted to highlight some other bits. We've, of course, got that ISM manufacturing PMI coming out. It's notable that the previous reading, as you can see here, 47.8, that stands in stark contrast to the standard S&P global manufacturing PMI reading, which is a 52.2. So who's in the wrong here? Because one says manufacturing in the US is doing hunky-dory. The other one says it's in trouble. So a rebound in terms of that manufacturing number from ISM would be particularly notable if it does come out. Also, we've, of course, got these jobs numbers. So JOLTS job openings expected to decline somewhat, not too much. ADP non-farm payrolls also expected to decline from 140K to 125K. Bearing in mind, I'm recording this on a Thursday, so these numbers are liable to change because these are sort of initial early estimates. And that goes for anything on this show today because, because we're recording this Friday, it's a bank holiday here in the UK. So we do have sort of early estimates that we're looking at here. So keep an eye out on your favorite economic calendar for potentially more up-to-date versions of these numbers. And then Friday, we've got the jobs report, previous 275. Now, we've come off the back of 4 consecutive big beats in the jobs payrolls number. And, that would essentially point towards a US economy that is doing well. It doesn't necessarily need the rate cuts. And therefore, it points towards the potential for more sort of caution from the Federal Reserve and a longer wait for that first cut. Now, previously, markets had expected 7 rate cuts this year, starting in March. We're now looking for 3 rate cuts this year, starting in June. I think there's a good chance we don't even see it in June, quite frankly. But certainly some of the commentary coming out of the Federal Reserve does point towards a willingness to move even ahead of that decline to 2%. But I don't think we're going to see 2% inflation by June. And commentary coming from the Fed's Waller recently essentially said that he is willing to be patient because inflation doesn't necessarily signal the need to cut rates right now, which is exactly what I've been saying for months. In terms of average earnings, that's going to be key, of course. That's a proxy for underlying inflation pressures, 4.3% in the year-on-year figure, expected to decline down to 4.1%. So that continued decline is going to be key because this is another really notable metric that the Federal Reserve will be looking out for. So we're expecting to see a decline in terms of payrolls, but a 200K figure is still very respectable, and unemployment expected to remain as is. Average hourly earnings expected to rise to 0.3 on that month-on-month reading. So if that's what comes out, there's not necessarily too much to say the Federal Reserve need to cut rates straight away. So that could potentially lift the US dollar. I wanted to bring up the US dollar index. Let me just bring that up for you now. Here's the dollar index. The long-term perspective shows you the strength that we have seen in previous years gone by. Well, it's a lot more choppy at the moment. We have seen a period of strength because, of course, we've seen a realignment. This is a weekly time frame, by the way. We've seen a realignment in terms of expectations from the Fed. Well, the Fed were telling you they weren't going to cut interest rates a load of times. It was the market that seemingly got a little carried away with itself. So we've seen this rebound coming into fruition. The 4-hour chart shows you that we've seen the sort of latest leg up as we head in towards the weekend. If we were to see a relatively strong jobs market in the US, that would likely point towards further gains for the US dollar. And of course, if you're not trading the dollar index, this is just a good indication of the potential underlying strength of one single currency, and therefore you can then pit it against a currency that you think could be potentially weak. That might be, say, the Swiss franc, because we've just seen a rate cut from them. It might be the euro, because we're expecting to see the ECB cut rates at June and possibly April. We've got inflation coming out from them this week. Ultimately, the dollar index gives us a good idea of the strength or weakness of the dollar in its own space. And so, yeah, I would point towards a possibility of further upside if we do come out with a relatively strong batch of data. I'm not expecting particular weakness this time around. So near term, we have got this sort of chop, but as long as we remain above 104, I think there is a possibility of near term a little bit further upside. Certainly if we see more commentary coming out from any Fed members, or we see markets repricing towards continued caution, continued patience from the Federal Reserve, and the possibility of them to not cut rates in June, which is currently the base case for markets, but I don't necessarily think it should be priced as highly as it currently is. Next, I wanted to talk to you about the eurozone. So eurozone inflation, let's just get my little head back in. Eurozone inflation is going to be the big ticket item this week, coming out on Wednesday, the 3rd of April. Certainly, I've provided a whole separate video for this, but essentially we've got these base effects where essentially we've got these really big numbers from last year being stripped out. That forms the basis for a potential sharp decline in inflation this time around. And in actual fact, when you look at some of these annualized readings, 11 months annualized, there is a chance we could even get down to 2% this time around. But if you look here, we've got an inflation rate of 2.6, a core inflation rate of 3.1. You might think, how are we going to get down to 2%? These base effects do point towards a possibility of that. It's just that we need to see a weak enough monthly reading this time around, and markets don't expect that. As you can see here, markets expecting 0.9 on the monthly headline inflation. So that wouldn't necessarily do us any favors, and that's why we've got this 2.6 expected. The caveat, once again, is these are early estimates from markets. But in the lead up to that, we've got the manufacturing PMIs from Spain and Italy. We've also got a number of final readings from some of the other countries in the region. We've got inflation coming from Germany on Tuesday as well. And then back end of the week, we've got services PMI numbers, factory orders, industrial productions, retail sales. So plenty to sink our teeth into. But the key trade here is the DAX. It continues to move towards the upside. And the question mark is, what's going to stand in its way? Well, inflation at the moment is already expected to come in at 0.9. So is it going to come in higher than that? I don't think so. And so the surprise would likely come towards the downside if it does come. And that would likely be beneficial for the DAX. I mean, ultimately, it continues to push onwards and upwards as it stands. Anyway, it seems to just not really care what's going on anywhere else, because soon enough we'll see rate cuts. And ultimately, as we see on the 4-hour chart here, this market continues to move higher. I wouldn't necessarily be looking for shorts on this index. If we were to break down through your price swing low of 18359, then we look for a wider retracement. But until that happens, it's just this continued step move towards the upside. The trend is your friend, and it's very clearly defined within this market. So the DAX certainly is the clearer one to be trading here. Whereas the likes of the euro, it's of course a case of saying, how are markets taking this data, but also what's the outlook for the other currency that you're trading against. So generally indices and commodities, a little bit more clear cut in terms of directional moves and often longer trends compared to FX, because FX, you're trading one currency against another. It means that you have to be right on one side, but also you have to be right on the other side, because something can change within that dynamic on either side of the trade that might move it in the opposite direction. So certainly, I think the DAX is the key market to be watching out for on the Eurozone front. And finally, I wanted to bring up the Canadian data. Of course, we have the jobs report coming out on Friday. We've got PMI numbers coming out. We've got trade data coming out on Thursday, the jobs report, like I said, on Friday. And we've also got potential volatility around the OPEC meeting, which is happening in this week ahead. And certainly, of course, OPEC have the possibility to move markets in terms of energy, and the Canadian dollar is highly reliant on energy prices. And certainly through the years, we have significant correlations between the Canadian dollar and the price of oil. So plenty of volatility ahead here. We have been seeing oil strengthening in the lead up to this week ahead. And we've also just seen some strong data coming out of Canada in terms of its GDP numbers, 0.4 on the latest preliminary GDP monthly figure, following a 0.6 the month before. So certainly things looking relatively strong, and it doesn't necessarily point towards the Bank of Canada cutting rates straight away. So let's look at a possible market to trade around this if we were to see possible Canadian dollar strength playing out, as is the case at the moment. So here is the monthly time frame for the Canadian dollar against the Japanese yen. And what we can see here is this big rally. If you're looking at, the trajectory over recent years, it generally has been towards the upside. And that does highlight this multi-year highs that we have been creating here. Now, of course, we saw that rate hike from the Bank of Japan, but if you're a one and done kind of central bank, you're probably not going to get a protracted move towards the upside for your currency. And that's exactly how it's been playing out. Look, we've got CAD against the yen moving towards the upside as we head towards the weekend. I think there's a good chance we see more of the same. If we see a breakup through this near-term resistance, that is 112.292, then it points towards this near-term pullback being that sort of retracement, and that the swing low is established. Until that happens, 108.676 is the swing low to look out for. But certainly, if we're looking for potential strength around the Canadian dollar, I think the CAD against the Japanese yen looks like a particularly interesting market to be following as we head into a week that not only has potential energy market volatility, but also has the possibility of volatility around the jobs report coming out on Friday from Canada, alongside, of course, what everyone's focusing on, the US jobs report. But certainly it makes for a potentially volatile end to the week, and CAD yen is the market that I'll be paying particular attention to.